What if the real secret to smart investing isn't wild algorithms or flashy day trading tricks, but something way simpler, something that actually makes sense in real life? What if all the best advice you need could be wrapped up in a story about finding a girlfriend? Today, I want to bust all those get-rich-quick myths and lay down a foundation for real, sustainable wealth. Let's cut out the noise and focus on what actually works. This isn't about magic stock picks. It's about a mindset that lasts. My name's Michael, and you're watching Investor Voice. Seriously, if you're just starting out, this is the only guide you need. Let me start with a story. There's this young guy, hungry to learn about money, who happens to overhear a millionaire talking about investing. He gets brave and asks, "How do you pick the right stocks?" The millionaire just grins and says, "Treat it like finding a girlfriend." Yeah, it sounds a little ridiculous at first, right? But there's something real behind it. When you buy a stock, you're not just grabbing a random number on a screen. You're actually buying a tiny piece of that company. You're now a part owner, even if it's small. And just like a relationship, you want to make sure it's a good fit, something healthy that can last. Now, I'm not going to tell you there's some magic crystal ball that shows when a stock will suddenly explode in value. The internet's full of so-called gurus who sell you that fantasy, but let's be honest, they're pushing dreams, not real strategies. Still, there are things you can do to seriously boost your chances of success. It's about being smart, not just hoping to get lucky. Think about dating. You need a plan, right? Are you going to be flashy and show off, or do you play it cool? Each approach leads somewhere different. The stock market works the same way. You need a strategy. There are two main ways to go: technical analysis or fundamental analysis. And trust me, they couldn't be more different. Technical analysis is the playground of day traders. These folks chase patterns in charts and price movements, hoping to guess what'll happen in the next few days or even hours. They believe they can spot trends and ride them for quick wins. I say believe on purpose, because honestly, most long-term investors, myself included, see this as gambling, not investing. Sure, a few people might win, but the odds are brutal. Data from places like The Motley Fool shows more than 95% of day traders lose money. They're up against massive institutions with fancy computers, and in the end, the house usually wins. Now, fundamental analysis is a whole different game. It's like being a detective, but for businesses. Instead of getting distracted by every little price jump, you dig into what really matters, the company itself. You look at their financials, check out their income, see who's leading the team, and figure out if their long-term plan actually makes sense. All of this tells you if the company is strong now, and more importantly, where it's heading in the next few years. This isn't about getting rich overnight. It's about getting rich slowly, the kind of wealth that sticks around. You build a portfolio of genuinely great companies, and over time, that's how you win. I get it. Slow and steady isn't sexy, and it probably doesn't help my watch time. But if you're here just looking for a quick win, this probably isn't for you. I want you to build a future, not just win a risky bet. And don't forget, investing always has risk. Your money can go down as well as up. But if you're still here, if you're really ready to learn how to build wealth the smart way, drop an "I'm in" down below. It lets me know you're serious. All right, let's dive in. Think about scrolling through a dating app. You check pictures, read bios. You're trying to figure out if someone's a good match, right? Investing in a company is the same idea. You need to check out the company's profile, what we call a balance sheet in finance. A balance sheet gives you a snapshot of where a company stands financially at a specific moment. It lays out three main things: assets, liabilities, and shareholders' equity. If those sound confusing, don't worry. We'll walk through a real example together and make it simple. I'll use Trading 212 for this. It's a handy platform for checking out and buying stocks. If you're in the US, you can grab the same info for free on Yahoo Finance. Just a quick note, this isn't personal financial advice. I'm not a financial advisor, so make sure you check things out for yourself. Let's say you want to look up the balance sheet for a company, Coca-Cola, for example. On Trading 212, scroll down to Financials, then hit Balance Sheet. It can look overwhelming at first, so let's break it down with an easy analogy. Picture a company's assets like a cookie jar. Current assets are right at the top, easy to grab, like cash, inventory, or money customers owe them. Anything the company can turn into cash within a year goes here. Long-term assets are lower down, maybe stuck under other cookies. Think of company buildings, factories, or equipment, things that stick around for years. Then there are intangible assets. These are more like the secret recipe, things you can't touch, but they're incredibly valuable. For a business, that means patents, trademarks, brand value, and goodwill. On the other side, you've got liabilities. Imagine these as cookies you owe your friends because you borrowed their ingredients. Current liabilities are debts or bills due within a year, the immediate stuff the company needs to pay. This shows how much pressure the company's under right now. So, what can you actually do with all this info? There's a quick way to check if a company's on solid ground: the current ratio. Just take total current assets and divide by total current liabilities. If the number's above 1, that's good. The company has more quick assets than debts. Let's crunch Coca-Cola's numbers. Their current assets add up to about $26.7 billion. Current liabilities? Around $23.6 billion. Divide those, and you get about 1.13. So for every dollar Coke owes in the short term, they have $1.13 on hand. That's a nice safety net. But that's just the first step. Before you trust someone new, you want to know about their past, right? Same goes for companies. You want to know their track record. That's where the income statement comes in. Think of the income statement as a school report card. It shows how well a company did over a certain period, like a quarter or a year. You'll see how much money came in and how much went out. You'll usually find it right next to the balance sheet. At the top, you've got total revenue. In 2023, Coca-Cola pulled in over $45 billion from selling drinks. But that's not all profit. As you move down the statement, you start taking away costs. First up, cost of revenue. For Coke, that's stuff like syrup, bottles, and manufacturing. Next, operating expenses, marketing, office costs, executive salaries, and so on. Subtract those, and you land on operating income. For Coca-Cola, that number looks great. Last, you see net income, the bottom line. This is what's left after every bill, tax, and interest payment. In 2023, Coca-Cola's net income was over $10.7 billion. Why does any of this matter? These numbers show how profitable a company really is. You can figure out the operating profit margin by taking operating income, dividing it by total revenue, and multiplying by 100. Generally, 5% is low, 10% is healthy, and 20% is high. For Coca-Cola, that margin is about 25.7%. That's huge, and it tells you this is a very efficient, powerful business. Just a heads up, older established companies usually have higher profit margins than the young, fast-growing ones. Amazon, for example, lost money for years while investors waited for that big growth payoff. Profitability matters, but it's not the only thing you should care about. Still, it's a big piece of the puzzle. And don't forget, just because something worked in the past doesn't mean it'll keep working forever. Let's be real for a second. If you're thinking about getting serious with someone, you don't want them to be terrible with money. That's a recipe for stress. Same goes for companies. You don't want to invest in a business that can't handle its own cash. That's where the cash flow statement comes in. A cash flow statement tells you how much money is actually moving in and out of a company over time. It's split into 3 parts: operating activities, investing activities, and financing activities. Operating activities is all about the cash a company makes from its main business, like selling Coke, if we're talking about Coca-Cola. You want this number to be positive. That means the company's regular business is bringing in more money than it spends. Coca-Cola nails this. Their operating cash flow is super strong, and that's a great sign. Investing activities is where you see money spent on future growth, buying factories, equipment, or other businesses. It also covers cash from selling off old stuff. This number is usually negative, and that's actually good. It means the company is putting money back into itself to grow. That's what you want. Financing activities cover how the company raises money and pays it back, borrowing, issuing stock, paying dividends, or buying back its own stock. You've got to watch this section. If a company borrows too much or pays out big dividends while operating cash flow is negative, that's a red flag. Imagine someone who lost their job but keeps buying expensive gifts for friends. That's not going to last. But that's not Coca-Cola's problem. They pay out billions in dividends, but their operating cash flow is so big, they can easily afford it. Now, have you ever met someone who seemed perfect online, but when you finally met, the spark just wasn't there? Same story with companies. A business can look amazing on a spreadsheet, but some things just don't show up in the numbers. That's why you need qualitative analysis. This is where you play detective. Go beyond the financials. Think about stuff that isn't in a spreadsheet. How strong is the brand? Are customers loyal? Do people actually like their products? If you want to be a smart investor, you need to dig up this info, just like Sherlock Holmes would. There are 3 big things you want to check out. First, brand recognition. If you ask people on the street what they think of Apple, you'll get loads of positive answers about quality and innovation. Apple's built an army of loyal customers. Ask about a brand like Xiaomi, and most people won't even know what it is. Investors feel safer putting their money in companies with a strong, well-known brand. It's like a moat protecting them from competition. Second, leadership. Look up the company's board, read earnings call transcripts, check out executives on LinkedIn. Who's running the show, and how long have they been there? Stability at the top is usually a good sign. These days, you also need to watch a CEO's public image. One impulsive tweet can send a stock tumbling. Remember when Donald Trump tweeted about Lockheed Martin's F-35 costs? The stock dropped over 2% in a single day, losing billions in value. So, picking a company with a steady, sensible CEO matters more than ever. Third, find out what makes the company hard to beat. This is their competitive advantage. It could be a key patent, a super loyal customer base, or a game-changing business model. Take Tesla, not just electric cars, but their exclusive charging network, battery tech, and software. These are gold for investors. They lower risk and boost your chances for long-term success. You'll pick up a lot just by poking around the company's website, reading industry news, and digging into some classic online research. Sure, it takes time, but getting a handle on these details can make all the difference for your investment. Honestly, it's way better to spend a few weeks doing your homework than to jump in blindly on some hot tip only to watch everything fall apart. Picture this. You hear some wild, negative rumor about the person you're dating. Your first instinct might be to panic and break up without even asking them what's going on. That's exactly how a lot of people react to bad news about a company they've invested in. They hear something scary, freak out, and sell right away, no questions asked. The news media only cranks up that panic. Think back to those first headlines about supply chain problems. What happened? Everyone ran out and bought up all the toilet paper, which ended up causing the very shortage everyone was worried about. The news made things worse. This same cycle plays out in the stock market. Fear-driven headlines spark massive sell-offs, and suddenly the stock price tanks, even if nothing's really changed about the company itself. Take the Cambridge Analytica scandal that hit Facebook in 2018. When the story broke about data misuse, the stock dropped almost 18% in just 10 days. People were terrified. But if you zoom out, you'll see Facebook stock actually climbed more than 200% from that low point over the next few years. That scandal? Just a blip for anyone thinking long-term. Investors who stuck to their research and held on ended up doing really well. So when should you actually sell a stock, especially with the news constantly stirring up fear? The truth is, the best reasons to sell usually have more to do with your own life than with market drama. Say you hit a real financial emergency and don't have an emergency fund. Selling some shares makes sense. Or maybe you finally reached a savings goal, like a down payment for a house or that dream trip. If the stock hits a price that makes you happy, there's nothing wrong with cashing in and enjoying it. From an investment angle, the main reason to sell is if your original reason for owning the stock no longer holds up. If your research shows the company's fundamentals aren't what you thought, or you just don't believe in its future anymore, it's time to move on. Think about dating again. You don't settle for the first person you meet. You look around, figure out what you want. The same goes for building your investment portfolio. There are two big types of stocks: value and growth. You need to know how both work so you can choose your approach or mix things up. Value stocks are usually big, established companies everyone's heard of. Their shares look cheap compared to their earnings. That's a low price-to-earnings ratio. These stocks don't swing wildly, and they often pay out dividends, regular cash payments to shareholders. Companies like Procter & Gamble, J.P. Morgan Chase, or Warren Buffett's Berkshire Hathaway fit this mold. Growth stocks are a different animal. They look expensive by today's earnings because people expect them to explode in the future. High P/E ratio. Their prices can shoot up or tumble fast, and they rarely pay dividends. They pour every dollar back into the business to keep growing. Think Amazon in its early days, or today's stars like Nvidia, Tesla, and Meta platforms. If you want a quick way to sort them, check the P/E ratio. Sites like Trading212 or Yahoo Finance make it easy to find. Historically, the market average is about 20 to 25. A much lower number? Probably a value stock. A much higher one? Likely a growth stock. But remember, industries are different, so always compare a company to its rivals. Once you've picked your style, make sure your portfolio is well diversified. Don't put all your eggs in one basket. If one stock tanks, you want others to help balance things out. A good rule is to keep any single stock under 5% of your total money, and don't go over 20% in any one sector like tech. Try to spread out across at least 5 different sectors in a couple of countries, and aim for 25 or more stocks altogether. That's how you build something sturdy. Spreading your investments like this lowers your risk and helps your returns even out over time. If you're watching this and thinking, picking stocks sounds exhausting, you're not alone. There's actually a much easier approach that works really well for a lot of people. Index fund investing. Instead of betting on just a few companies, you buy a tiny slice of hundreds, sometimes thousands of them all at once. That gives you instant diversification. Honestly, this is the strategy I use to build wealth for the long haul, and it's the last thought I want to leave you with. Investing isn't about hitting it big overnight. It's about patience, discipline, and keeping your eyes on the long game. You have to let compound growth do its thing, slow and steady, year after year. Treat your investments like a partnership that lasts, not a one-time fling. Tune out all the hype and noise. Focus on what matters and work toward a future for yourself and the people you care about. Thanks for sticking with me through this deep dive on Investor Voice. If this video made investing feel a bit more clear and doable, hit that like button. It helps the channel out, and it shows us you value down-to-earth financial advice. Make sure to subscribe to Investor Voice and turn on notifications so you don't miss any of our upcoming deep dives. We've got more content coming on building wealth, understanding the economy, and making smarter choices with your money. Now, I want to hear from you. What's stopping you from getting started with investing? Is it fear, confusion, or just not knowing where to start? Let me know in the comments. I read every single one. And if you've got a friend who's always talking about investing but hasn't made the leap, share this video with them. You might be the spark that gets them going. That's it for now. I'm Michael, and this is Investor Voice. Stay curious, be patient, and remember, wealth takes time, but you only build it if you actually start. See you in the next video.